So as I said before we were starting off, our audience is primarily passive investors. What are some of the key tax benefits of investing passively in real estate syndication as limited partners, and how can individuals maximize those benefits?
Yeah, it's a great question. I mean, I think the first one that comes to my mind is, I think people don't always look at it like this, but it's investing in real estate syndication is obviously the goal is for that real estate to generate cash flow. But a lot of times early on, that cash flow is sheltered by depreciation losses. You may get, as a passive investor, you might get a distribution check of $10,000, but your K1's not going to show $10,000 of income. It might show zero. It might even show a loss. So I think that's one of the main benefits that people need to not forget about is when they're investing in these passive syndications, that a lot of times they're getting cash flow and it's sheltered from taxes for at least the first couple of years for sure.
Does the choice of legal entity, an LLC, LP, or S Corp, affect how the passive investor's tax liability is, and what factors should they consider when they're making that decision?
Yeah, that's a great question. Purely from a tax perspective, it doesn't make a difference at all. One of the benefits of being a passive investor is that generally there's already asset protection built in, right? The property, the fund, the syndication is already in an LLC itself. On the tax side, we're not very concerned with needing another level of entity. It's oftentimes that just creates more paperwork than necessary. That said, the benefits that you typically see on a syndication investment, whether that's the fund maximizing write-offs or depreciation, cost segregation, they all come to the passive investor in a pretty package on the K1, all wrapped up. So the investor doesn't even have to do anything in order to get that tax benefit on the K1, right? And so this is true regardless of whether the passive investor is investing in their personal name or in an LLC that they own. We even have investors who invest using their retirement account, like a self-directed IRA or 401k. And so in all those scenarios, basically what we get as the passive investor is the K1 that already reflects all of the strategies on the fund level, which is reducing the rental income for tax purposes.
Gotcha. I want to get to the IRA investing here in just a moment, but I want to backtrack just a bit and get you to explain a little bit for maybe somebody who's new to investing in real estate, how the depreciation works for passive real estate investments.
Depreciation is kind of what we jokingly refer to as ninth wonder of the world. When you buy rental real estate, whether it's you're on your own or passive syndications buying the rental real estate, obviously the goal is for it to go up in value. It's to generate positive cash flow. But from a tax perspective, the IRS actually allows you to write off a portion of that purchase price every year because of normal wear and tear. So as if it's depreciating in value, right? Now, that depreciation is based on the purchase price. So it's not, a lot of times you'll see the syndications, they'll buy a $5 million property, but they've raised $1 million. The depreciation's calculation starts at $5 million, not the $1 million the investors put in. And so that's why I was talking, it's like a paper write-off where it's maybe something the bank was paid for part or a good chunk of it, but you still get to write that off on the taxes every year against that positive cash flow. That's the way where investors, whether again, passively through syndication or on their own, can use that depreciation to kind of offset the income from that property.
Does it cross over into other assets that you own? I've often heard depreciation sometimes described as a bucket. You get a big bucket of depreciation, and then when you choose to take it is often up to you. Is that correct?
It depends. So if I have a single family home, my own rental property, there is some control, not in whether I take depreciation or not, but there is some control over how quickly I take depreciation. For example, if I'm not able to use the loss or I don't really need the loss, I might just take regular depreciation. So meaning the building, I'll just depreciate over 27.5 years, slow and steady. But if I'm someone who can utilize the upfront depreciation, I could do a cost segregation and accelerate that write-off. So that's where our choice comes in, whether taking it in the normal sense or accelerating that benefit. With respect to passive investors of syndications, unfortunately, the choice is not made by the passive investor, right? Just like with the investment decision, usually that is made at the fund level. So the sponsor group, the GPs are going to be the one to decide whether we're going to take accelerated depreciation or not. Now, when the K1 comes to the investor, that's where the strategy will come in. So let's say I was a passive investor and I got this great distributions and my K1 shows a tax loss. I'm really happy. Now, the next question is, what kind of income can that K1 loss offset? Is it just my other rental income? Is it other passive income I have? Is it my W-2 income? That level of planning is something that each investor should be doing with their own CPA to figure out when and how is the best way to utilize that benefit.
Gotcha. And that was my next question. Is it possible to offset W-2 income with losses from passive real estate investments? And I know you're going to say it depends, so we'll start there.
Did you read the sign behind us that says it depends?
Yes.
Yeah, there are ways that people can use passive real estate syndication losses to offset W-2 or other types of income. Generally, they do need to be qualified as what's called a real estate professional for tax purposes. And that's going to require them to have probably their own properties, their own long-term rentals where they're spending time on those. But if they can qualify and they have the right facts and circumstances, then yeah, they're investing on the side in these passive syndications that are kicking off K1 losses because of depreciation early years. They can definitely use that depreciation in the right circumstance to offset their other income as well.
Gotcha. But it's not going to work for a doctor or a lawyer, somebody who's not an active real estate professional, correct?
Well, probably not in that scenario, but to change the facts a little bit, what if that doctor is investing passively in those deals and he's got their own passive real estate investments? Not a real estate professional, but they've got their own rental properties, and maybe those are showing positive income. They could definitely use the losses from the syndication to offset the income from their own rentals and thereby sheltering the taxes they were going to pay on those for sure.
And we also see if this doctor is married, right? So maybe they're still working full time, but their spouse is the one dealing with their own smaller portfolio of properties. And so, if the spouse is a real estate professional, she met the right number of hours on the real estate activities, then it is possible to also invest in syndications and use those losses against the physician income. We see that actually a lot. So a lot of clients, because to invest in most syndications, you have to be accredited, right? Which means somebody is either has a lot of assets or making high income. And what we often see is people say, oh yeah, I want to be a real estate professional. I want to have a bunch of rentals of my own. And then I'm able to use the losses against the income. But over time, people get fatigued, right? It's like, okay, I had 3 rentals. It was great. Now I have 6 rentals. And then next year I'd have 10 because I keep chasing that tax benefit. So this is where syndications work really well because if, again, like Matt said, if you're a real estate professional with your own portfolios, then you can always scale up by investing in more passive syndications to continue to get the tax benefit without creating a full-time real estate job for yourself.